Are you someone who has heard about investing but feels like it's just too complicated or risky and that you need to have loads of spare cash in order to actually do it? Well, in this video, I'm going to explain in the most basic terms how investing works and the best, simplest way to start doing. Now, this is for the complete beginner, so if you're not a complete beginner, then you might want to leave because this video probably isn't for you. So here's a good intermediate video on investing. Watch that instead. If you're still here, then when you finish this video, you will understand exactly what investing is. And if you then decide to actually go ahead and begin your investment journey, be sure to stay to the end of the video where I will explain the safest way you can invest. So our journey into understanding investing starts with a simple question. What happens to money over time? Well, over time, the value of money can change. And this is due to two important factors, inflation and interest. So inflation is simply another word for rising prices. So when someone says, what is the inflation rate? They are simply saying, how fast are prices rising? So what causes inflation? When things cost more to make, sellers pass that cost on to buyers by increasing prices. So for example, when the price of oil rises, it costs manufacturers more to make things because oil and energy is used to run the factories and transport the goods and so on. So manufacturers pass that cost on to buyers by increasing the price of what they are selling. The other reason why prices rise is when there is more demand for a product that can be met by the makers of that product. Because so many people want the product and there isn't enough to go around, the makers of that product can raise prices and people will still buy it because they want or need it but can't get it anywhere else. So how does this relate back to money and time? Well, if you had £100 and you wanted to buy Gizmo X, which also costs £100, then of course you could. If, however, you kept that £100 under your mattress for 1 year, then took it out and went to go and buy Gizmo X again, well, you might find that due to inflation, Gizmo X now costs £110. Its price has gone up and your £100 is no longer enough to buy it. It's really the purchasing power of that money gets weaker over time. The other way that money can change in value is from interest. Your money gains interest when you lend it to a bank. Now, you might think you are depositing your money into a bank to keep it safe. But in reality, what you are doing is lending your money to the bank so that they can use it for their own ends. And they will pay you for that, and that payment is called interest. So what does all this have to do with investing? Well, stick with it as we are nearly there. The trouble with inflation and interest is that the typical rates of interest that a bank will pay you for depositing your money with them is significantly lower than the rate of inflation. Right now, in July 2023, the rate of inflation stands at 7.9% in the UK. So if Gizmo X cost £100 last year, well, it now costs £107.90, and the £100 under my mattress, well, it can no longer buy it. But what if I put that £100 in a bank? Well, a typical interest rate right now is 5.3%. So my £100 would now be worth £105.30. Still not enough to buy Gizmo X. I can't buy now what I could buy last year. I've become poorer. Now, if only there was a way for my money to increase in value more than the speed at which prices are rising. Well, there is, and it's called investing. Though, as with most things in life, it's not guaranteed and there are risks. But crucially, there is a way to invest that minimizes that risk. And we'll come to that once we understand investing a little better. Investing is the word used to describe buying an asset. An asset is just something that gives you money over time. A common example is a house. You buy a house for, let's say, £100,000, and if you rent it out, you might get £10,000 a year from your tenants coming back into your pocket. It is also very common for the intrinsic value of that house to increase over time. Remember our friend inflation. And so house prices rise. So owning property has always been a very popular way to invest. but it does require a lot of money up front and a lot of work and time managing the property, finding the tenants, and so on. But there are other cheaper and easier ways to invest. And so finally, we get to what most people think about when they hear the word investing: stocks and shares. First things first, the words stocks and shares, they mean the same thing, so you can use either of them interchangeably. But what do those words mean? A stock or a share is nothing more than a symbolic part or share of the value of a business. If I owned a lemonade stand and you bought a 10% share of it, well, I would have transferred 10% of the value of my business over to you. Let's say my lemonade stand business was worth £1,000. You then, as a 10% share owner, would own £100 of my business. If in 1 year my lemonade business was valued at £2,000, well, you could sell your 10% share and get £200 back, a £100 profit. So that is one way that the asset, or your share of my lemonade stand business, could put money into your pocket. Another way would be that if my lemonade stand was doing well and I was making a profit, I could decide to reward the people who invested in my business by giving them a part of that profit each month. And this is the second way that the asset you bought could put money back into your pocket. And this reward is called a dividend. And that's it. That is all investing is: buying an asset, in this case, a small part or share of the value of a business. All that is required for this to work is that the business you bought into increases in value over time. And of course, that is where the risk is. My lemonade business could easily go bust and disappear with your investment. So how can you protect yourself from this? You do this by not investing in a single business at all, but instead you invest in a collection of businesses, or what are known as index funds. And to understand what an index fund is and why they are a less risky investment option than my lemonade stand, well, you need to watch this video here. But all that's left to do now is to like and subscribe because, well, the video's over.